What if the money you're working so hard to save right now is quietly becoming less valuable every single day, and no one is telling you the truth about it? What if the next 18 months don't just bring another market dip, but a deep shift in how wealth is protected, destroyed, or transferred? Most people believe that doing what worked in the past will keep them safe in the future. But history shows the opposite. When economic systems come under pressure, the rules change and those who don't adapt pay the price. This is exactly why a small group of investors consistently survive crises, while the majority are left confused, angry, and poorer than before. One of those investors is Ray Dalio, a man who didn't build his reputation on guesses or trends, but on studying hundreds of years of economic cycles, debt collapses, currency failures, and recoveries. His warning today is not emotional, not dramatic, and not designed for headlines, which is what makes it dangerous to ignore. He believes we are entering a phase where traditional assumptions about savings, investments, and safe money no longer hold up the way people expect, and according to him, most individuals are positioned exactly where they shouldn't be. The real problem isn't that people don't work hard or don't earn enough. The problem is that they trust systems without understanding how fragile those systems become under stress. Inflation doesn't announce itself loudly. It slowly erodes purchasing power. Market crashes don't give fair warnings. They punish overconfidence. And governments don't default overnight. They dilute value gradually. This is how wealth is destroyed quietly, not suddenly. Ray Dalio's concern is that people are preparing for a future that looks like the last decade, while the next decade is shaping up to look very different. This is not a video about panic, fear, or predicting the end of the world. It's about understanding patterns that repeat themselves every time economies reach this stage. Dalio's message is simple but uncomfortable. Survival in uncertain times doesn't come from chasing returns, hype, or popular assets. It comes from positioning yourself so that no single event, policy change, or market shock can wipe you out. In this video, we're going to break down the core idea behind his warning and explain the 4 types of investments he believes are most likely to survive what's coming. Not for billionaires, not for hedge funds, but for anyone who wants to protect their financial future before the rules change again. The global financial system looks stable on the surface, but history teaches us that stability is often an illusion created right before major shifts. Markets don't collapse because people expect them to. They collapse when confidence quietly fades. Right now, we are living in a period where debt levels are historically high. Interest rates have risen rapidly, and governments are under pressure to keep economies functioning without triggering panic. This combination has appeared many times before, and it never ends the way people hope it will. What makes the current situation unique is how interconnected everything has become. A policy decision in one country instantly affects markets across the world. Currency values fluctuate not based on productivity, but on confidence. And for the average person, this creates a dangerous sense of false security. Salaries still arrive, markets still open, and digital numbers in bank accounts still look normal until suddenly they don't. Wealth destruction rarely announces itself loudly. It creeps in slowly through inflation, currency dilution, and declining purchasing power. This is where long-term thinkers separate themselves from short-term optimists. One of the investors who has consistently warned about this phase is Ray Dalio, whose work focuses on understanding repeating economic cycles rather than reacting to daily headlines. His core idea is simple. When systems become stretched, they eventually rebalance, and that rebalancing is rarely painless. This chapter is not about predicting an exact crash date or spreading fear. It's about recognizing that we are late in a cycle where risk is underpriced and certainty is overestimated. When people believe this time is different, history usually proves otherwise. The question is not whether change will happen, but who will be prepared when it does. One of the biggest mistakes people make during uncertain economic periods is assuming that doing nothing is the safest option. Holding money in familiar places feels comfortable because it requires no action and no difficult decisions. But comfort is often the enemy of long-term financial survival. Inflation, even at moderate levels, slowly eats away at purchasing power, turning saved money into silently shrinking value. When inflation rises, people often focus on prices going up, but they rarely focus on what's actually happening underneath. The value of money itself is being diluted. Governments don't typically solve debt problems by paying them off. They solve them by reducing the real value of what they owe. This happens through money creation, low interest rates, and policy decisions that prioritize stability over savers. The result is a hidden transfer of wealth from those who hold cash passively to those who own assets. This environment rewards awareness, not optimism. Historically, periods like this don't destroy wealth evenly. They punish people who rely on a single source of financial safety. Savings accounts, pensions, or even one investment class can all fail to protect value if conditions shift against them. The danger isn't volatility, the danger is concentration. Understanding this doesn't require advanced financial knowledge. It requires accepting that money is not static. Its value changes based on policy, trust, and global conditions. The people who survive these periods best are not necessarily the smartest or richest. They are the ones who recognize that preservation matters more than growth. When uncertainty rises, this chapter sets the foundation for everything that follows. Before discussing specific investments, it's critical to understand the environment they exist in. Because no asset performs well in isolation, it performs within a system. And when the system is under pressure, only certain strategies remain resilient. Gold has played a unique role in human history, not because it produces income or innovation, but because it represents something rare in modern finance: permanence. While currencies rise and fall, gold has remained a store of value across empires, wars, and collapses. This is not nostalgia, it is pattern recognition. When trust in financial systems weakens, people instinctively move toward assets that exist outside political control. Gold doesn't rely on earnings, interest rates, or economic growth. Its value comes from scarcity and universal acceptance. That is precisely why it performs well during periods of uncertainty. When currencies are being diluted and debt levels are questioned, gold often acts as a counterbalance. It doesn't make you rich quickly, but it helps prevent you from becoming poor slowly. Critics often dismiss gold because it doesn't generate cash flow. That criticism misses the point. Gold is not designed to outperform stocks during economic booms. It is designed to preserve purchasing power when confidence in paper assets declines. In a world where central banks can create money instantly, scarcity itself becomes valuable. Another overlooked factor is institutional behavior. Central banks around the world still hold gold as part of their reserves. They do this not out of tradition, but because gold provides neutrality in a system built on competing currencies. When institutions with the most information continue to value gold, it sends a signal worth paying attention to. Gold is not about predicting disaster. It is about acknowledging uncertainty. In diversified portfolios, it plays the role of insurance, and like all insurance, it matters most when things go wrong. Cash is often misunderstood during inflationary periods. People assume holding cash is always a losing strategy. Over long periods, that can be true. But during uncertain economic transitions, cash plays a very different role. It provides flexibility, optionality, and psychological stability when markets become irrational. In times of stress, assets don't fall evenly. Panic creates forced selling, margin calls, and liquidity shortages. When that happens, opportunities emerge, but only for those who have liquidity. Cash allows investors to act when others are frozen. It turns volatility from a threat into a resource. The key distinction is how cash is used. Holding cash permanently without a plan exposes it to inflation. Holding cash temporarily during unstable periods allows it to be deployed strategically. This is why experienced investors don't view cash as an investment, but as a tool. Another benefit of cash is protection against bad decisions. When markets are volatile, emotions take control. People chase rebounds, sell bottoms, and follow narratives rather than fundamentals. Cash provides distance from this emotional cycle. It allows patience, which is one of the most underrated financial advantages. In uncertain environments, survival often depends less on what you own and more on when you act. Cash provides timing flexibility. It doesn't eliminate risk, but it reduces the risk of being forced into decisions. This prevents being forced into decisions at the worst possible moment. This chapter is not arguing for hoarding money indefinitely. It is arguing for respecting liquidity as a strategic asset. In times of change, the ability to wait can be more powerful than the desire to act. Stocks remain one of the most effective long-term tools for wealth creation. But not all stocks are created equal, especially during unstable economic cycles. The mistake many investors make is assuming that past performance guarantees future safety. In reality, market stress exposes weak business models quickly and brutally. During uncertain periods, companies with high debt, weak cash flow, or speculative growth projections are the most vulnerable. When financing dries up and consumer demand slows, only businesses with real profitability and essential services remain resilient. This is where selective diversification becomes critical. Diversified stocks do not mean owning everything. They mean owning companies across different sectors, geographies, and revenue streams. Businesses tied to basic needs, energy, healthcare, infrastructure, and consumer essentials tend to perform better when growth slows. These companies may not deliver explosive returns, but they are more likely to survive. Another overlooked factor is global exposure. Companies operating across multiple regions are less dependent on the economic health of a single country. In a fragmented global economy, this geographic diversification matters more than ever. Stocks should not be approached as short-term bets during uncertain times. They should be evaluated as ownership in real businesses with durable demand. When markets overreact, strong companies often get priced irrationally. For disciplined investors, this creates opportunity, but only if risk is managed properly. This chapter emphasizes a shift in mindset, from chasing growth to prioritizing durability. In late economic cycles, survival is the foundation of future gains. Real assets represent something fundamental in a world dominated by digital finance. Physical utility, real estate, infrastructure, farmland, and commodities exist outside financial abstractions. They provide services people need regardless of economic conditions. This inherent usefulness gives them resilience when currencies lose value. Real assets tend to adjust with inflation because they are directly tied to real-world demand. Housing, transportation, food production, and energy don't disappear during downturns. Their prices may fluctuate, but their necessity remains. This makes them powerful tools for preserving purchasing power over long periods. Unlike financial assets, real assets cannot be created instantly. Land cannot be printed. Infrastructure cannot be duplicated overnight. This scarcity becomes increasingly valuable when money supply expands faster than real output. However, real assets are not risk-free. They require management, maintenance, and long-term commitment. Liquidity can also be lower compared to stocks or bonds. This is why they work best as part of a broader strategy rather than a standalone solution. The purpose of real assets is not rapid appreciation. It is stability anchored in reality. In times when confidence in systems declines, tangible value becomes more attractive. People may debate prices, but they rarely debate usefulness. This chapter reinforces a recurring theme. Survival comes from owning things that remain valuable regardless of narratives, policies, or market sentiment. The most dangerous belief during uncertain times is overconfidence. Many people assume that intelligence or effort alone will protect them financially. History proves otherwise. Economic cycles don't discriminate, they punish imbalance, not ignorance. Diversification is often misunderstood as a strategy for average returns. In reality, it is a strategy for survival. By spreading exposure across assets that respond differently to stress, individuals reduce the risk of catastrophic loss. This doesn't guarantee success, but it dramatically improves resilience. True diversification is not about owning many assets that behave the same way. It's about owning assets that respond differently to inflation, deflation, growth, and crisis. When one struggles, another stabilizes the overall structure. Another critical factor is time horizon. Short-term thinking magnifies fear and mistakes. Long-term thinking allows volatility to work in your favor. Those who understand cycles are less reactive because they expect turbulence. This chapter highlights that financial strength is not built through prediction, but through preparation. You don't need to know exactly what will happen to position yourself effectively. You need to accept uncertainty as permanent. Survival is not passive. It is the result of deliberate structure. The coming years are unlikely to reward blind optimism. They will reward clarity, discipline, and adaptability. Financial systems evolve, but human behavior remains consistent. People underestimate risk during stability and overreact during stress. Those who understand this pattern gain an advantage. This is not a call to fear or withdraw from markets. It is a call to think independently. Wealth is not built by following narratives, it is protected by understanding incentives, systems, and cycles. The future will belong to those who value resilience over perfection. No strategy is flawless. No asset is immune. But balanced positioning reduces vulnerability and increases opportunity. At Money Uncovered, the goal is not to predict the future, but to prepare for it. Understanding how money behaves during uncertainty is one of the most valuable skills anyone can develop. Because when systems change, those who understand the rules adapt, and those who don't are forced to react. And in finance, reaction is always more expensive than preparation. As we move forward into a world that feels increasingly uncertain, one thing becomes clear: money doesn't disappear overnight, it shifts hands. Those who understand how financial systems really work don't panic when markets shake. They prepare long before the headlines turn negative. The difference between losing ground and staying ahead is rarely luck. It's awareness, structure, and the willingness to question comfortable assumptions. The goal is not to predict every move the economy will make, but to position yourself so that no single event can destroy everything you've worked for. If this video helped you see money, risk, and security from a new perspective, then you're already thinking like the people who survive every cycle. This is exactly what we do here on Money Uncovered. We break down complex financial ideas, global trends, and real-world money decisions in a way that actually makes sense. Without hype, without fear, and without empty promises. If you want more videos that help you protect your wealth, understand how the financial system really operates, and make smarter long-term decisions, make sure you subscribe to Money Uncovered. Turn on notifications so you don't miss upcoming deep dives into money, markets, and the forces shaping your financial future. Because in a world full of noise, clarity is power, and here on Money Uncovered, we help you find it.